Hey, what's up, Path to Freedom? And thank you for dropping into another episode. This is episode 130. Today, my guest is Jeremy Dyer. Jeremy's someone that I've really enjoyed getting to know a little bit over the last month or two. Got introduced to him through Franchoice, the consulting network that I'm a part of. Jeremy is the founder of Starting Point Capital, where he specializes in real estate investments, primarily focused on multifamily housing. So, this is really a real estate syndication, which is something that, I would say, dabbled in a little bit over the last couple of years, meaning I've been trying to better educate myself. I've even had a couple of other guests on the podcast previously that do similar types of real estate investing. However, what I've always run into is the fact that, there's just a lot of noise out there. There's a lot of people, out there kind of claiming to do the same things. And so I got introduced to Jeremy, was on a webinar that he led a couple of weeks ago and, was really impressed by, not only his knowledge, but his ability to really communicate in a clear way, how he and his partners or sponsors were set up, how they were differentiated, and what their strategy was to, do everything in their power to make sure that their investors got a strong return. So to me, there were some clear differentiators between Jeremy's approach and other syndicators that I've seen out there. Also, some people that I know and trust very well have invested with Jeremy through Starting Point Capital and have gotten great results. So the other thing I found really interesting was the fact that, Jeremy talks in this episode about the fact that, earlier 2000s, he and his wife had a fix and flip business, and, that went well for a while, but they kind of got to this point that a lot of business owners get to where they just run out of time. They don't have any more time to trade. And that's where he really made the shift to investing in multifamily real estate, a much more passive type of investment. And I think that's something that any entrepreneur, any business owner should be thinking about, whether you're at that point already where you don't really have any more time to trade, or, if you're just getting started in your business ownership journey. At some point, you're going to reach, your maximum bandwidth. And, hopefully if your business has gone well, you're going to have more resources than you have time. So that's where, something like multifamily real estate investments can really, be a nice thing to kind of redirect to more passive income. A business is never going to be entirely passive. So really interesting interview. I hope you guys enjoy it. Jeremy's fantastic. So without further ado, let's go ahead and drop in with Jeremy Dyer of Starting Point Capital. Jeremy, thanks so much for joining.
Yeah, Wes, thanks for having me on. And you're exactly right. I think we met each other about four or 5 weeks ago now. I feel like I've known you for a long time, though, because you're kind of slowly becoming the king of franchising. Your face is all over social media. So thank you for the great content that you're bringing to people.
Yeah, thanks, man. It's a lot of fun, and king of franchising. That's a big title to fill. There's a lot of people out there that I've learned from over the years that probably deserve that title better than I do. But I enjoy, trying to put information out, help people understand franchising. And, I just put out a podcast this week that, really kind of emphasized a point that I try to articulate to people all the time, which is, franchise ownership is great. It can certainly be a vehicle to helping people, take more control of their lives and ultimately create more freedom for themselves. But it's not a passive investment. There's different ways that you can get into franchise ownership, and there's some business models within franchising that are going to, maybe require a little less time from the franchise owner than others, but it's not a passive investment. And so I think, for anyone to ultimately achieve freedom. And I think freedom means different things to different people, but usually it heavily involves, really having control of their time, but also having the financial resources to live the type of life that they want. There's got to be more to their financial strategy. And I think that's where someone like you really comes in. So, personally, I'm fascinated with what you're doing. I'm trying to better educate myself on different types of passive income opportunities. So again, thrilled to have you here because I know that, there's a lot I can personally learn from you, but same goes for the audience. So tell us a little bit about, what you do at Starting Point Capital and the type of passive income that you're able to help people create.
Yeah, I really appreciate that. It was a great kind of overview and great segue. So I am a very big fan of franchising. So I'll get that out there right out in the open. I've owned a couple of different businesses myself, both of which I've exited out of. So can absolutely appreciate, busy professionals, higher income individuals, individuals that are looking to, kind of replace their dependence on the W-2, so to speak, and get into active small business ownership, because I too was there myself.
Yeah.
One example of that being an active fix and flip business that my wife and I started back in 2012, purely out of our love for real estate, really.
Yeah.
So neither one of us are real estate agents, but we were going out, we were buying single family homes with the goal of fixing and flipping them and trying to turn a nice profit. We started doing that in 2012. Things started getting very competitive in that space. So competitive to the point in which we were putting in hundreds of offers on houses only to hopefully get one under contract.
Wow.
Second to that, we also doubled down on children and went from 2 kids to 4 kids. And for your listening audience who has children, as they start to get older, they demand more and more time, especially windshield time.
Yes.
So we found ourselves, driving all over the place to their various activities. And it just got to the point where the active side of that business, we were no longer going to be able to support a proper work-life balance. So we made that decision in 2015 to exit our active fix and flip business. And instead, we started to invest passively into what I call real estate syndications.
Yep.
Back in 2015, I didn't even know what the word syndication meant, right? It was all new to me. I used the investing in real estate shotgun approach, held my breath, plugged my nose, sent my wire transfer in, and just kind of, did the whole, Hail Mary type thing.
Yeah.
And it paid off in a big way. And, fast forward to, just a couple of years ago, my wife and I are passive investors in 25 real estate syndications, most of which are in the multifamily space. And a couple of years ago, purely out of our passion for wanting to educate others about the benefits of passive real estate investing, we formed a company called Starting Point Capital. And Starting Point Capital exists primarily for 2 reasons. Number one is to educate busy working professionals on the benefits of passive real estate investing. And number 2, to bring solid investment opportunities to those investors that we have engaged into a meaningful relationship with.
Yeah, it's fascinating. And we're going to get into a lot more detail on, exactly how you're able to help people through Starting Point Capital. But, I'm interested in a little bit of the learning experience that you went through from, the time you exited the fix and flip business, started, looking to invest more passively, because I think, when people start looking at these real estate syndications, I know this has at least been my experience. It seems like there's a lot of noise out there. There's a lot of people doing it, or, I guess even claiming to do it. So, where did you start, and, what are maybe some of the things that you've learned over the years that, looking back on it, you would say, hey, I would have done this differently had I known better?
Yeah, great question. I wouldn't change the fact that we were active business owners. Okay.
Yeah.
I would not have changed that because it allowed me to really truly learn about real estate.
Okay.
It allowed me to learn about the underwriting process and how to, force the net operating income to, decrease expenses, to bring, an improved asset to market. It taught me about relationships with banks and lenders and brokers and those types of things. So I wouldn't necessarily change that, but the genesis of the question really comes back to something that you brought up earlier, and that is this notion of time freedom. Okay. Yeah. That was really the major defining reason why we chose to transition from active swinging hammers and dealing with tenants, trash, toilets, and termites to instead taking that same capital and investing that capital with a trusted sponsor or syndication team that we trusted would be able to put our investment money to good use to produce consistent cash flow and returns to the tune of very similar returns that we were getting on the active side. It's just now we were doing it passively. So I would say the time freedom was a huge one. When you go from 2 kids to 4 kids, okay, all right, that's double the trouble, or
Going from
quadruple the
2 to
trouble.
3 kicked our ass. So I can't even imagine 4. I can't imagine it. It just scares me.
Yeah. And so everybody has their why. That was our primary why. We just ran out of disposable time, right?
Yeah.
We didn't have any bandwidth in order to be able to scale that business, because that business was at a place where, for your franchise audience maybe listening to this, when they have location number 1 up and running and they're starting to think about scaling to location 2 and location 3, that's really where my wife and I were at that time. We had a few, properties that we were fixing and flipping and managing, but to really scale it to that next level, it was going to require a much larger, not monetary investment, but a much larger time investment.
Right. And I think that's a pretty normal trajectory, right? For a lot of people is, early on, they have more time and they don't have as much financial resources. And I think that's where, owning a business can really be a key part of the strategy for someone. If you're willing to really work hard and build a business, I think in a lot of cases, it's reasonable to expect that over time that business can generate, more income than a lot of times you could expect in a W-2 position, giving you more financial resources. But at some point, with businesses, you're gonna get to that point where you just don't have any more time. I mean, my wife and I were in our late 20s when we started our first franchise. We didn't have, a whole lot of financial resources. We certainly didn't really have any business at that point in time looking at different passive income opportunities. So starting a business was great because it very quickly got us to a point where not only did we have more control of our time, we were working hard, putting a lot of time in, but we got to kind of control what that looked like versus someone else. That was great because we were just starting to have a family. But it very quickly got to the point where the income was exceeding, what we were making as corporate employees. And then we got into a second business, which was also good. And then I started my consulting business. So now all of a sudden we've got 3 businesses and then, 3 kids. And we're just at the point now where there's no more bandwidth, right? Like we need to simplify as it is, but we've got some resources now that we didn't have back then. So now is really the time, for us to start shifting our focus to, okay, how can we put this money to work for us in a smart way? And I think, more and more people are realizing that the investment strategies most of us were taught growing up, put your money into a retirement account, put your money into the stock market and kind of hope for the best. I think a lot of people are finally realizing that there's a lot of other ways, to go about making your money work for you. And so that's why, I love what you're doing and the types of opportunities that you're bringing to people. So for those that are maybe not familiar with what a real estate syndication is, maybe give a quick overview of that. And then, how does that tie into what Starting Point Capital is doing?
Yeah, it's a great question. And thank you. So, real estate syndications are basically nothing other than group investing. Okay.
Yeah.
It's where a group of investors are able to come together, pool their capital together, and deploy that capital into a real estate opportunity. And it doesn't necessarily have to be real estate. I mean, you can syndicate all kinds of different things, right?
Yeah.
Mostly what Starting Point Capital is laser focused on is the multifamily space. But as an investor myself, I am invested as a limited partner in other asset classes like assisted living, self-storage, RV parks and marinas. There's a lot of different asset classes that people can invest into, but real estate syndication from a high level is basically just group investing. So what we're really looking to do is find good operators that are in excellent markets, that have exceptional track records, and partner with those operators when they get to the point in which they have a new opportunity under contract. Most of our operators focus in the multifamily space where the properties were built primarily in the 1980s, 1990s. All the interior units are all classic in nature, which means that they were built 40 years ago. They all had, they all currently have Formica countertops, white appliances, old flooring. Maybe the pool's been decommissioned, right? So we're really looking to provide value into those properties to burn off what we call loss to lease. Once we're able to do that and execute that renovation effort on a large scale, typically 200 plus units in most of the communities that we invest into, we're obviously looking to exit. So we typically try to invest into opportunities where we can accelerate our investment as quickly as possible. And we typically try to invest into opportunities where that projected hold period of the investment is anywhere from 3 to 5 years.
Okay. So and when you say multifamily, it's primarily apartment complexes, right? So you're going out and you have partners that are going out and finding these opportunities to buy an apartment complex that, is ready to be upgraded and kind of, bring it up to, more modern living standards, I guess would be one way to put it. And through this syndication, someone who has some capital, but not enough capital to go out and buy an apartment complex entirely on their own, they can get in on this. And usually it's a 2 to 5 year kind of timeline before they can expect to really see a return on that investment. Is there any cash flow opportunity on the investment in the holding time?
Yeah, great question. So two things. One thing that you brought up earlier was this idea of leverage, okay? Leveraging other people's time. That is huge. We didn't come back to that, but when you're an active small business owner or you are actively in real estate, you have no leverage. It's your time, okay? Yep. Whereas in passive real estate investing, we're really leveraging the operator's time, and we're merely a passenger on that flight, okay? Yeah. We are, however, putting a lot of trust and faith and confidence in that operator's ability to execute the value add business plan, right? So correct. I regularly refer to the sponsor as being the jockey on the horse. We're not betting on the horse. We're betting on the jockey to be able to see, and to be able to frankly run that race. To answer the second part of your question, we only look to invest in opportunities that produce immediate cash flow and provide an equity upside to investors with tax benefits. So most of our investment opportunities will start to produce what are called cash on cash distributions to be paid to investors, typically within the first couple of months of us purchasing that asset. That's not always the case with every investment opportunity, but it's the whole risk reward, right?
Sure.
Typically investments that produce a higher degree of cash on cash return to the investment or investor early in the process are typically going to have maybe a lower equity multiple or lower equity split when that deal goes full cycle. So it's really up to the investor to not only do their own due diligence on the opportunity, but really to self-assess what type of investor are you at this point in your life, right? Are you more of a cash flow investor where you need that regular reoccurring, monthly income from that investment? Or are you more of an equity type investor where maybe you're willing to take on a little bit more risk, right? When you invest into syndications, but there's a greater potential of a higher upside at the end, when that investment goes full cycle.
Yeah. Can you afford to wait to start really seeing the return and in the hopes that return is going to be larger versus starting to see some of that return a little bit sooner? With starting point capital, a lot of the value that you're adding to someone that's looking to invest is some of the partnerships and the relationships that you have with, the operators and kind of the boots on the ground, because that is such a key part of this. And, I'm certainly not an expert, but I've looked into, real estate syndications in the past, and where I always kind of got stuck was just the trust part, right? Like, who is the right syndication to partner with and to invest my money in? Because, at the end of the day, conceptually, they're all kind of doing the same thing, right?
Yeah.
But just like in anything, there's going to be some people that really know how to execute, that really know how to find the right deals. And there's going to be others that are not going to execute as well. If you're listening to this podcast, then there's a good chance that you're looking to create more freedom in your own life. There's also a good chance that you realize that owning your own business can be a great way to take more control of your livelihood and create more of that freedom that we're all looking for. Also, if you've been listening to the show for a while, you realize that I specialize in franchise ownership. In addition to owning franchise businesses myself, I have a franchise consulting firm, Path to Freedom, where I help people navigate what is typically an overwhelming process of understanding franchising, identifying specific franchise companies that could be a fit, and then conducting the due diligence in a thorough and efficient manner with those franchise brands. My whole purpose here is to leverage my experience working for franchisors, owning franchises myself, and how we've been able to use that to create more freedom in our lives and help you determine if that could be a path that makes sense for you as well. So if any of this sounds interesting, if you've considered business ownership in the past, whether you've explored franchising specifically or not, I'd love to connect with you. I'd love to learn more about you and what it is that you're working towards in your life and determine if I may be in a position to help. A great starting point is the link below in the show notes, which will take you to a short form to fill out, and you'll receive a free copy of an ebook that I've put together, The 7 Steps to Freedom Through Franchise Ownership. That'll also get us connected, and I'd love to set up an introductory call where I can explain a little bit more about the process that I use to help people determine if franchise ownership could be a great way to start charting their own path to freedom. So click the link below in the show notes, receive the ebook, and let's get connected. I'd love to hear from you. Talk to us a little bit about some of those key relationships and partnerships that you have. I mean, I'll leave it to you in terms of how much detail you want to go into, but I know for me, when I got a little bit of a peek under the hood of how you're set up and how some of your partners operate, it started to click for me, and it made a lot of sense. And there were some kind of key differentiators from what I'd seen and some of the other syndications out there that I'd looked into.
Yeah, no, that's a fair question. And to be honest with you, that is the most important question.
Yeah.
Okay.
Yeah.
And that is the track record of the sponsor, right? So we align ourselves with what I would refer to as excellent sponsors. Okay, there's the good ones, there's the great ones, and then there's the ones that have kind of achieved that level of excellence. And really, it's important for people to understand that not all sponsors are equal. You have sponsors or syndication teams in the space right now where maybe it's a team of 2, okay? Maybe it's a team of 10, or maybe it's a team of 250. They're in multiple markets. They're vertically integrated on the property management side, on the building construction side. These things are all incredibly important for investors to understand. I would personally never invest with a sponsor that just got into the space 2 years ago and it's a couple of guys in a truck, right? Like I wouldn't trust that sponsor team is going to be able to execute a value add business plan if they've never done it before, right?
Yeah.
So I want to know about the track record. I also want to know that sponsor has an adequate amount of skin in the game. What I mean by that is I want sponsors that I'm raising capital for and that I'm investing my own money with. I want to know that they're putting at least 5 to 7% of their own money into the investment opportunity, right? That shows me that there's a true alignment of interest there. I also want to know about times where the sponsor has gone through adversity, right? Did they go through the global financial crisis in 2008 and 2009? How did they fare during COVID? How are they faring, during times of maybe low occupancy, okay? Or maybe natural disasters. So I really want the sponsor to unpack some of the times where they've really kind of fallen down and what they've done to get back up. Because one thing that's true about real estate, whether it's on the single family side or multifamily side, stuff is always going wrong. Nothing ever goes exactly as planned because it's real estate, right?
Yeah,
And
totally.
So thank you. That was a great question.
Yeah, because I mean, there's a lot to actually execute one of these, right? I mean, there's some complexity to it where you need someone that really understands what that process should look like. I mean, I know just from sitting in on a webinar that you put together a few weeks ago, some of your partners are, like you said, vertically integrated, meaning they employ the people that are coming in and actually doing the work, on one of these apartment buildings to upfit the units. But it's not like you buy the place, you kick everyone out and you redo everything at once. You've got to be strategic and kind of do it in phases so that you're maintaining some level of cash flow. So there's managing all of that. To your point, when you're doing any sort of construction or remodeling, the only guarantee is that something's going to go wrong. Right. And usually it's more than just, one thing. So yeah, you really want strong operators. I mean, I think the other big piece here too is just, people that know how to go out and find the right types of deals and have the relationships in place to find the right types of deals, because it's not like, you guys are going to Zillow or some online marketplace. Oh, there's an apartment building for sale. Let's look into that one. Maybe we make an offer on that. The types of deals that are going to be attractive for you and your partners or the sponsors that you're working with, they're probably never hitting the open market, right? So how important are some of those relationships just in the sense of being able to find the right types of opportunities?
Yeah, no, that's a great question too. And this is very much a team sport. It's a relationship business. And to your point, there are only certain operators out there today that can provide the seller with an assurance of close. And that's a really big thing as well. So we certainly do, have opportunities where they've been sourced off market. We do have opportunities, where the broker that hears of a property about ready to be marketed really only brings it to one sponsor. Okay.
Yeah.
Because
you at least get a heads up that, hey, this is coming to market and you get to, kind of take a look at it before there's a feeding frenzy.
Yeah, that's exactly right. And right now in the current, environment in real estate, there's really not much of a feeding frenzy. Okay. Buying is down, depending upon the market, anywhere from 70 to 80%. So there's just not a lot of opportunity, available in the multifamily space right now, just because transaction volume has largely dipped. A lot of people are wanting to sit on their low fixed interest rate loans, or perhaps maybe they aren't looking to, sell a property and give the next buyer a 20% discount. So, there's all kinds of factors that are going on in real estate right now. But yeah, that's a good point, that it's absolutely a relationship business, and it's very much, who and having a sponsor or a syndication team that's well capitalized, that has those broker relationships, intact, is incredibly important to the overall, health and well-being of the investment.
And so really all of these relationships, all of this kind of strategy, know-how, ability to execute, that's a lot of what you're bringing to the table for the people that you work with, right? Is you've gone out, you've developed these relationships with, sponsors that have a proven track record of executing and generating the type of returns that they expect to, versus someone like myself who's not experienced in this yet, having to go out and try to figure it all out on my own. And then the value that you're bringing to the sponsors is you're helping to raise capital for the funds that they're raising to go out and do these deals. Is that an accurate kind of way of describing the relationship or the ecosystem that exists here?
Yeah, that's right. I mean, you can think of it like, it's very much a networking play, right? So, I encourage all investors to do their own due diligence, right? Sure. You want to do your own due diligence on sponsors that I raise for or sponsors I don't raise for. By all means, please, trust but verify, right?
Yes.
But in most cases, our investors are really, leveraging our expertise, us knowing who are the, A players in the space right now, that have the track record, that have the relationships intact. They've largely been a rinse and repeat operator. They've, not only hit projected returns for investors, but they've exceeded them, right? Yeah. And they're fully transparent. I think communication from the operator is incredibly important. I will tell people I would rather put my own personal money with an operator that's providing me transparent monthly updates on how the business plan or the execution of that business plan is going versus chasing, a higher IRR from another sponsor because they put out a glossy pitch deck. That makes sense.
Yeah, it makes total sense. Very similar to what I do with my franchise consulting, right? I work with 250 brands out of thousands, right? But these are very high quality brands that have been vetted very thoroughly. But that doesn't mean everyone I work with, A, needs to invest in a franchise, or B, needs to invest in one of the franchises I work with. There's some really great franchises out there that I just don't have a relationship with. There's also some really crappy franchises out there that I don't work with. And for that reason, but it's not my role to make decisions for people, whether they should invest in a franchise, which franchise they need to go do the due diligence themselves. What I bring to the table is some established relationships that, I feel really good about, and I can help point people in the right direction. But at the end of the day, they've got to do the research. They've got to make decisions for themselves. So I think there's some interesting parallels there in terms of, your role, Starting Point Capital's role, and all of it. So I'm thinking of the listener out there that's intrigued by this and maybe wondering, when is the right time to start really looking at these types of investments. So I imagine some common questions are, how much capital are we talking about? Like what's kind of the minimum amount of capital that someone would need to be able to invest in something like this, and also to the extent that you're able or comfortable, what types of returns are possible. I mean, this is investing, this is business. There's no guarantees. Nobody has any crystal balls, but it does seem like through a lot of analysis, you guys are able to project certain ranges of returns that you're at least shooting for your investors. So what would someone need to have on hand to think about doing this, and what type of ROI potential is there to be had?
Yeah, thank you. That's a great question, and thank you for the crystal ball disclaimer.
Yeah, I have to use it all the time on this podcast.
Yeah, no, it's so true, and nobody really has a crystal ball, right? I don't know what exit cap rates are going to look like in 5 years from now. Nobody really, even the experts don't even get it right. You know what I mean? So it's important just to understand, that from an investor perspective, that nobody has a crystal ball. And obviously, I mentioned it earlier, trust but verify, do your own due diligence. You've got to assess what type of, risk you're willing to take as an investor. But one of the things that I personally really like about the multifamily space is that if you look at the risk return profile of multifamily investing and stack it up against any other investment, okay, that could be anything from stocks, bonds, mutual funds, cryptocurrency, you name it, okay, sticking your cash under the mattress at home. Multifamily has the highest return and the lowest risk out of any other investment vehicle that exists over a 50 to 100 year period. Again, obviously fact check me on that, but that is that's why I'm in that asset class. But I really appreciate the question about diversification. Okay, I think the right type of investor to invest into a multifamily real estate syndication or with Starting Point Capital is an investor that is looking and seeking diversification. Okay, I got into real estate in 2012 because I had maxed out my 401k for a decade. I was trying to find the next Tesla, Amazon, Facebook stock. I was winning 1 out of 10 times and losing 9 out of 10 times, right? So I was really looking for that diversification play into something that's a hard asset that meets the needs of all human beings, and that is we all have to have a place to live, right? And it's not one of those emotional investments, okay? It's not one of those investments that you can just hit the refresh button and you can see the value of your investment going up and down. Real estate moves very slowly, okay?
Great point.
Yeah, it's not a get rich quick scheme. It's certainly a get rich slow investment strategy, but it does take 5, 10, 20 years in some cases to really hit a home run. Typical investments that we look to bring to our investor network from a return perspective are typically going to be in that 16% internal rate of return or IRR range, which is usually an annual rate of return of around 20%. And then we really try to target a 2x equity multiple on investors' capital. So we typically are shooting to double the investor's money within anywhere from a 3 to 5 year projected hold period. And then our goal is to help that investor execute what's called a 1031 exchange into the next real estate investment opportunity so they can avoid having to pay taxes on those gains. We also perform what's called a cost segregation study on all of our investment opportunities so that we can produce as much passive depreciation loss activity as we can, which is just merely a paper loss to the investor so that that can lower any potential tax consequences that they would see as a direct result of the distributions that they're receiving on that investment, as well as the equity profit that they receive at the end at the time of disposition.
Yeah, that's a great point that I'm glad you brought up, and I'm sure we could do an entire separate podcast just on some of the tax benefits that if you're strategic, you can benefit from with these types of investments. And I think diversification is key, right? I mean, there's very rarely any instance where it makes sense to have all of your eggs in one basket. But I think especially for high income individuals that, kind of like you have maxed out retirement funds and are looking for a way to diversify, this can also be a good way to, offset some taxable income.
Yeah, that's right. And you had mentioned earlier or had asked about minimum investment. So
Yeah.
there are opportunities to invest into real estate at a lower minimum. Our minimum is 50,000 per
Okay.
investment, but
Right.
there are other ways through publicly traded REITs and some crowdfunding type opportunities for investors that are not able to meet, what our minimum is. But for those investors that are able to meet our minimum investment metric on a per deal basis, I am also a huge fan of diversification in real estate. So we often have investors that come to us and say, Jeremy, I've got this, stagnant $500,000, IRA that's doing nothing for me. Can I use the money in that IRA to self-direct into one of your real estate, deals? The answer is yes. Okay.
Wow.
But I don't want them to put all of it into one opportunity. Okay.
Yeah.
I
Yeah.
would encourage them to, invest, say, $500,000 in multiple investment opportunities, as they become available. Again, I'm a huge fan of diversification, and it's amazing what happens when you stack investment opportunities on top of one another. When it comes time for some of these deals to go full cycle, the compounding effect of investing in real estate is absolutely incredible.
Yeah, I mean, run that scenario, 500K across 5 different investments, if they come anywhere close to, what's typically being projected, once it's all said and done, compared to just leaving that 500K in an IRA or whatever, it's massively different.
That's right.
That's a really kind of exciting scenario to think through. So, I could sit here and ask you questions about this stuff all day. There's clearly a lot, to understand with any type of investment before you, actually deploy any capital. You're clearly a phenomenal resource when it comes to all of this. I know that you also put a lot of great information out there. You've got a website that's got a ton of free resources on it. You do a podcast as well, which I want to make sure we tell people what the podcast is, where to find it. But what would you suggest for someone that's, again, sitting here listening to this has piqued their interest? They feel like they're in a position or nearing a position to really start seriously thinking about these types of investments. Where's a good starting point for them to go, and continue to educate themselves and start working towards being ready to actually make an investment into multifamily?
Yeah, and thank you for highlighting the name of our business, Starting Point.
I realized after I said that, I didn't even plan that, although I should have just taken credit for it.
Yeah, so we paid big money for that name. No, so Starting Point, there's 3 things. All right. I would highly encourage your listening audience to head over to startingpointcapital.com. Again, startingpointcapital.com. We have a free passive investing guide or ebook available. We've got a great blog section out there with frequently asked investor questions. They can learn more about past deals that we've raised investor capital on. The second thing that I'd encourage your listening audience to do is read a book. Okay. I'm a huge fan of a book by the name of Hands Off Investor. The author's name is Brian Burke, Burke with an E on the end. I, like you, could have this conversation for the next 15 hours straight. Yeah. But I'd highly recommend people pick up a copy of that book. It is available on Audible. So if you're an ADD person like myself and you'd rather listen to the book versus read the pages, you can probably crank it out in 8 hours at 1.5 speed. The last recommendation, is please do give me a follow, give me a listen. We did launch a podcast called The Freedom Point Real Estate Podcast, which was launched about 3 weeks ago, and we're producing 3 episodes per week. So we'd certainly welcome your audience. Check us out at The Freedom Point.
Awesome. We will link all of that in the show notes to make it easy for people to find the website. Definitely encourage people go download the ebook that he's got, or the guide that's up on his website. I've taken a look through that. A lot of good information on there. We'll link the book and the podcast as well, but yeah, tons of good information out there, free resources that you guys are providing. What should someone do if they're ready to really have a conversation about, investing with Starting Point Capital? What are the steps that they should take?
Yeah, certainly head over to my website. There's a Calendly link at the bottom of the homepage. Certainly go ahead and feel free to pick a time on my calendar, set up a call, and look forward to learning more about your audience's goals and what they're kind of looking to get into or out of, and happy to consult and make any suggestions or recommendations for them that I feel is appropriate based on where they are currently in their life journey.
Awesome. Jeremy, great stuff. Thank you so much for everything that you're doing. Thank you for being here on the podcast, but really huge fan of, all the education that you're doing and helping people, work towards creating true freedom for themselves. I'm a big fan. So thanks a lot.
Thanks for having me, Wes.